Hi, my name is Trent Chapman, and today I want to answer a question I got from one of my homeowners that I'm helping with a short sale transaction. Now, this client had tried to do a loan modification before, and their main concern was that they didn't want to have to move. They really liked the area, they liked the schools their kids were going to, and their concern was not having to move out and start over. But they decided to change their attitude and look at this as a positive thing once we understood their actual financial position they were in. Now, they had income that was coming in, but not sufficient to qualify for a loan modification, but it actually ended up being a blessing in disguise. And in this case, they were $150,000 negative in equity because their home value dropped so much based on what they had borrowed against it versus the current fair market value. They had $150,000 upside down in equity. So in this case, they had $350,000 borrowed against the property, and it's now worth about $200 to $215,000. So they really were not in a good position to stay in the home and where it made good financial sense. Basically, if you're doing a loan modification where your home equity is negative by $100,000, $200,000, $300,000, it's like getting a new loan and taking an unsecured line of credit or a credit card for an amount of $100,000, $200,000, $300,000, whatever it is that you're negative in equity. Whereas doing a short sale in many cases gives you the opportunity to wipe out that debt and prepare yourself and your credit to be able to buy again, and maybe not in the exact same house, but typically in the same neighborhood or a similar neighborhood where the prices have come down so much from the time that you originally bought that you actually pay less monthly on the home, and you'll be able to have a lower cost basis in the property. So when the property values do go back up to $350,000, $400,000, instead of being break even on your mortgage, you now have a couple $100,000 in equity, which is really what people look for and hope for in a home. Is one, to own it outright, which is hard to do when you owe $350,000 when it's worth $200,000, and two, to have equity or the ability to have equity in the future based on buying it at the low price and it appreciating in value as you pay down the balance. Now, if you're in a situation where you're not sure what option is best for you, it's best to analyze all options and see how it affects you in the financial future and yourself 10 years from now, 15, 20 years from now. How would you look back on your decision and say, was that a good decision to modify? Was it a good decision to short sell? Was it a good decision to let it foreclose? Now, it really depends on your specific situation. There's a lot of my clients that want to do a short sale, but after taking a second look, there are possible ways for keeping them in the home through a modification or through private financing. So just because one option sounds good for one person, it may not be the best option for you and your family. If you have any other questions you'd like to ask me, go ahead and shoot me an email. You can fill in the box down below, or you can give me a call. Talk to you soon.